So today we're actually doing, talking about managing business financials. In this session, you'll learn some about financial statements, how to use balance sheets as a key tool to manage your small business more effectively. So a little bit about me as far as why I'm qualified to stand in here to talk to you guys. I'm actually the small business sales manager for the Inland Empire market. So I cover about 9 small business specialists, and my territory covers all the way from up to Bakersfield, Kern County, San Bernardino County, all the way down to Pasadena. I've been in banking for going to be 16 years in a week or two, 16 years. I just joined the small business team last September. Prior to that, I was in the retail branch, so I was a branch manager for about 10 years or so. So a lot of banking experience, and I'll have Kate here introduce herself.
Hi, good evening. Thank you, everyone. Good evening. Thank you so much for your time tonight, and it's great to see everyone here. Like Jane, welcome back. I know you were here last month. Yeah. So I'm the business asset advisor with US Bank, and I'm the person that focuses on Asian segmentation. So my job is really like either work with organization like ABA for financial education, or I work with business minority business owner. Because the reason that our group exists and is because we know that most of the resources are in English, and they're focused on people who grew up here or they got like a long credit histories in the United States. But like us, if either we're new immigrants, we're like the first or second generation of immigrants, sometimes things like our situation or our background is a little bit different. And we do feel like some of the information doesn't really take into those factors into consideration. So that's why my team is here. We specialize in supporting minority-owned business. And then we either connect, share information, or connect the business owner with the right capital or the right financial institution.
So we'd like to take this moment to get to know a little bit about you. So I would love to kind of hear your name, what your business is, what you do, and how long you've been been running your business. So I guess we can just start in the front here. Yes.
Okay. My name is Helen. I'm a one-person creative agency providing brand strategists and visual design for mostly small to mid-sized businesses. I have been in business only for about a year. And that's pretty much all. At the same time, I signed up for Asian Association, Asian Business Association.
Well, congrats! A year in, so
yes. Yes.
Yeah, my name is Jean. I'm in the financial business for 17 years. Just like you, I start at 2. Focus on the personal and the business retirement plan, like the 401k, single IRA, personal IRA, Roth IRA, something like that.
So this is going to be a review for you.
Oh,
yeah.
That's good. Yeah, so that's my business, and our company, Transmeasure, has 70,000 agents, licensed agents. So it's a huge company.
Thank you.
Oh, my name is Peng. We're from a dessert company called Coconut. So we specialize in coconut desserts. And now we've been doing this business for almost 5 years. We started in Costa Mesa, like Irvine area. And then now we have over 100 vendors in SoCal, and then we're in Irvine and Costa Farms.
Yeah, congrats on that.
Yeah.
Me? Yes. My name is Ja. I co-own Coconut with my husband, and which is specializes in dessert manufacturing. Thank you.
Good. In the back.
Yeah. I'm Chris Esqueta. I am an independent insurance agent, so I'm licensed with property casualty, life and health. I'm the commercial department of our family's agency. My mother's the matriarch of the business. We've been around for over 30 years. I recently came back fall of 2019, so probably about 3.5 years in, and kind of looking to expand. 2020 was slow, and then just kind of hit the ground running hard. End of 2021, and so on and so forth, and looking to add another co-producer to work on the field with me. So it's Yeah, so I found the topic very interesting and applicable to what I'm doing right now. Thanks.
Hi, I'm Monica. I work for AT&T. I've been with them for about 4 years now, a little over 4 years now, and I'm in their data and analytics section, and I advise on their media investment allocations.
Hi, welcome.
Hi there.
Hi, we're just doing introductions. If you'd like to introduce yourself.
Sure.
Yeah,
My
name,
name.
your business, and how long you've been running your business.
Okay. My name is Kenny Chung. I'm an attorney by training. I work with my family. We do a couple of different lines of business. We're in the denim jeans manufacturing business. We also invest in and manage commercial real estate properties, and then we recently started doing a vegetarian restaurant out in Temple City called Happy Food Kitchen.
But I didn't know you did the denim thing. Like, there's so many things you do.
Oh, that's our main business.
I know.
Yeah.
So he's a realtor too, right? And
We're a realtor.
He's a lawyer.
One-man
He
show.
is. Kenny of all trades.
Yeah. So it sounds like we have a very diverse group today, so I'm sure we'll learn a lot from each other, from everyone's backgrounds and experiences. So again, I want to thank you all for joining us, and we'll be discussing again. We'll be discussing the managing financials and just different tools that help to keep us organized and importance of it, of how to run a small business. And I think one biggest thing, I was talking to Kay as we're walking here, is we've worked with a lot of clients coming into the branch, and we've seen all types of clients. You know, the mom and pop ones. We've helped with large corporation type clients, and one thing we've really seen is a lot of business owners are great at what you do. You might be amazing at making desserts, but you might not be the best at managing your money, you know, and that's just that's just the reality of it, right? You can be great at just that one thing because you were born to do that, or you know, you crafted whatever the product is or the service you're you know, providing to your clients. And the money management part is hard because it is scary, you know, and I'm sure Jean here can even talk to a lot of its you know, clients that you worked with in the past that are, you know, makes a lot of money, but they still mismanage. You know, they mismanage, and they're like, well, I make, you know, $1 million. How come I have nothing to show for it? So we're hoping today you'll kind of learn just some of like the how to track your money, and then just some key terms on what to look for when it comes to, you know, those banking terms. And what I hope to help with you guys today is how do banks look at through the eyes of a lender, right? Through the eyes of how, if you were to come to us and be like, hey, I want to get a small business loan, what are some of the things that we look at to ensure that you are that, you know, type of customer that we would likely to lend to? And if we don't get to everything in the session, please, you know, raise your hand. We'll have time at the end for questions. And then we'll also provide our contact information if you have any questions via email. That way, guys, if anything comes up to your mind. And of course, Kate, with her role as business access advisor, you know, her primary goal is to help you guys to access to capital, access to information. So if there's anything that we didn't get to, please jot that down, and we'll hopefully be able to get that answer. So first off, what I would like to do is kind of talk about some of the benefits of financial management and just a high-level overview on financial statements. So in order to reach your goals, it requires to make good decisions with your company. So first question I'd like to ask is, you know, and not to ask for you guys to answer, but it's like, how does the business make money, right? How does a business grow? What does a business have to set up to expand and diversify? And you kind of think about that. And when you think about when you're running a business, it's pretty general. You know, whether you're manufacturing, you know, some goods, it starts with money, right? It starts with some type of investment or capital to start that business. And you have to use those goods to use that money to purchase the goods, and it goes through that cycle. But just really tracking your money is the way how you can reach your goals, because you need to know exactly at what step your money is being spent on. So the benefits of financial management is just really knowing your value. Generating financial data will allow you to identify your assets, liabilities, and equity at any given moment. This will help you understand your profit margins and allow you to manage your business more effectively. Because when you think about the cost it takes to make something, you have to also consider how much profit will you make from selling that certain good. And then the next one is forecasting your growth. And forecasting and just having that really futuristic mindset of where you want to see your company grow, whether it's 5, 10, 20 years. And it is really hard to think because long-term planning, a lot of people tend to not want to think of that. And like again, Jean, with what you do, a lot of customers are scared to think about long-term planning, for their retirement. People probably at the age of 40 to 50 probably don't even have a retirement plan just yet. And for small business owners, that's the same thing that we come up with too, is that they don't have the succession planning. They don't think about, once your business hits a certain cycle, whether if you're a new business, a startup, or you're already at the end of the cycle, you're not growing anymore, where do you see your business growing after that? And then finally, prepare your financing, loans, and I kind of mentioned this earlier. Thinking about, do you have the proper funding? Do you need additional financing to achieve your goals? And maintaining proper bookkeeping practices, because that's going to help you overcome some of those obstacles and growth opportunities. And the proper financing it's even better if you're able to use someone else's money than your own money. And I think this day and age for a lot of business owners, they realize the power of being able to use other people's money, not theirs. But I know personally for me, like my family are small business owners. And mind you, I've been in banking for over a decade, and when I do talk to them about it, they don't even know where to start with loans and with all that. And it's just crazy to think that when we think about asking for money, and Kate was saying that there's a lot of minority-owned business owners don't even know where to start, and being able to know like the information as far as what we're going to teach you today and also where to start is just the first step in helping your business grow. And it's just the information that we're going to be providing you today. And then we'll have some exercise to kind of explore some more of these. So I talked about basic bookkeeping, and we're going to kind of talk about the cycle of how the bookkeeping works and kind of the operating cycle of it, right? So as the business moves through the business, as a business owner and you move through your business process, there are ways to make your business more efficient and profitable. Generating financial statements as a tool will help you to see the opportunities as well as the gaps you have in making your business profitable. So remember to track all your finances going in and out of your business routinely. It is great to seek a CPA, right? That's a no-brainer. A professional bookkeeper to assist you, or any software like QuickBooks. But obviously, some small business owners don't have the capital to afford some of that. But there are different softwares like QuickBooks that it is affordable to kind of help you keep track of all that. And nowadays, with the banking systems, there's a lot of ways for you to kind of transfer a lot of your transactions into these type of softwares to really help organize, all of your finances. So, the first piece is reconciling your accounts and making track your sales. So just knowing if you have the financial health to repay, tracking everything that you have. Depositing the sales into business account. If you are a business owner, the first thing to do, if you are thinking about becoming a business owner, the first thing to do is to start your business via opening an account. If you go to the bank and you open an account, you do not necessarily need to have your account, your business up and going. As long as you have your business name established, whether you're doing a DBA or filing with the Secretary of State, that's all the information that we would require to get your account started. So that would be your very first step in doing that, because at that point, anything you do, you can funnel any purchases or anything through that specific account that's for your business account. Pay expenses from business accounts. this part, you think, yeah, of course, you have to pay your expenses, but you may not know that there are a lot of business owners that commingle their personal and business expenses together. And this happens a lot. And when you do that, it's gonna be hard for your accountant or your CPA, whoever you work with, because you're gonna have to go in and look at all your bank statements and kind of look at line by line item to see, which items are for business purposes, and it's gonna be pain for you during tax season. If you have everything, you're kind of smiling in the back. Is that something that you have experienced in the past?
After getting married, yeah.
But it's very common. It's very common. Even when you get married, things get commingled. So. Yeah.
That's normal. It's okay. It's okay. I was wondering. You said earlier, just kind of back up a step. To open a business account, so some people may not file a Secretary of State. Could they still do it, or do
Yeah.
they need a? What I guess it's under that company name.
Yeah.
What
So
document do you
it depends. Like, are you a home-based business, or are you gonna be doing business like at an actual like a storefront or something? A lot of times, if you are a startup, let's say you're doing e-commerce, right, and you're like an Etsy little store, and you're making little trinkets, right? So and then we'll say, Joanna Ho, DBA, Joanna's Fashion Jewelry, right? And every bank has their own guidelines, but to speak to US Bank, as long as you come in and have your name established, right? Whether you do a DBA, fictitious filing, but we don't require that to start the account. So that'll be like the very basic is a sole proprietor. If you wanted to get it started. So technically you don't require any documents.
So
you
just
can even
need
use
a
your name. You can
and
just
then
use your
you'll
name.
track based on my social.
Correct.
Correct.
Yeah. You can actually create an EIN if you like to.
What?
Under a sole prop, if you like to, that's optional, but I would advise you just talk to a CPA if, you wanna go that route. Of course, there's different tax benefits, so definitely talk to, is anyone a CPA here? No? Definitely talk to them to see, if there is a need to do that. But we've had a lot of clients that have done sole props their entire life, and that just works for them, So it just really depends on, your business, how you run it, and, what recommendations your CPA has. Next is, once you have everything set with as far as you're tracking all your sales, you're putting everything in your account and you're paying your expenses, you have, all those transactions, you're able to generate financial statements, through invoicing, your balance sheets, P&L, and just having that cash flow awareness. And then finally, don't forget to pay yourself. I think that's one thing that business owners don't do, is don't just transfer your money out into your account. I mean, like really pay yourself, right? Or write an actual check and make sure whether you W-2 yourself, whatever the case is, so make sure you pay yourself. Again, don't be commingling the funds, don't neglect this piece. This is important because you wanna make sure that, you have income that you're reporting under your personal taxes. Because that's considered as income earned under your business. So that's important to make sure that you have. And then, quick tip is that, like I mentioned earlier, you can link your QuickBooks bookkeeping software to your US Bank account and online banking. So now the online banking that we offer through US Bank is very advanced, where there's a lot of different features where it allows you to help track a lot of your spending. Is there any questions so far? All right, financial statements. So financial reports, like I mentioned earlier, they're a compilation of statements about a business, financial health and cash flow. So it tells you the health of your business. There are 3 basic statements that provide different ways to view your company's performance, and they're useful tools for analyzing company's value and often a requirement for obtaining additional financing. So these are the 3 statements that we actually look at the bank. So if you were to come to me and be like, hey Joanna, I'm looking for a $100,000 cash flow, like line of credit. I'm like, great. The first couple things I would ask you is, what are your gross annual sales? How much are you netting? How long have you been in it? Just very simple questions like that, right? Gross annual sales and net income is really important to know right off the top of your head for your business because it allows you to know where your business is at. How much money are you generating coming in through sales and how much are you actually profiting? That's like the basic two things that we would ask when you're requesting for something. So cash flow projections, the first one, it's sometimes called cash flow statement. It estimates the money that you have coming in and out of your business. So the projections can cover a 12-month basis, and typically you can create monthly, weekly, or semi-annual. Profit and loss is also called an income statement, and it shows you the revenue and expenses during a particular period. So usually, we would ask you for a P&L if you're applying for a loan, if you had not filed for your taxes this year. So right now, we're at July 2024, right? And you're requesting for a loan, obviously you didn't file for your taxes. So we would request for a P&L year to date to today to see where your company is at. So that's technically your paycheck, right, to show how much earnings you have. And obviously you would request for your prior year tax, filed tax returns. And then finally, balance sheet. It's the financial statement that reports assets, liabilities, and shareholder equity. And this is how the business looks like at a point in time. And then Kate's actually going to go through more in detail on how these look like and just a kind of a basic spreadsheet on, you know, how they generate these numbers. And then, yeah. So today we'll be focusing a lot on the balance sheet statement and how you can use key financial data to manage your business more effectively. So we can see now how some of these are linked. So the cash flow, two primary purposes of this, and the cash flow statement displays how much money you have to cover, for each month to cover expenses like making payroll or buying more inventory. It's tied to the operating cycle of the business. Cash flow statements have two primary purposes that allows the administrator to, one, identify the cash received less than the amount of cash paid over a period of time, and review the cash moving in and out. So right here is how much cash is, how much you're starting with and how much is coming out. This talks about how much cash you have available, and then right here at the end kind of tells you how much you end out with. So this is a typical cash flow projection on what you would anticipate, you know, month over month, based on the sales that's coming in. So when you look at the first row, the title sources of cash, this documents all incoming cash, including cash from customer sales, interest earned, loan funding, current checking and savings account balance is up here. The second section, operating uses of cash, it contains all expenditures associated with day-to-day buying and selling process. Most expenses show up on the P&L statement. And then again, right here at the end is non-operating uses of cash, and it shows expenses not associated with operations, equipment purchases, principal portions of loan payments, inventory, taxes. This is where you subtract your uses of cash from total cash available, and you have your ending cash for the month. And that ending cash will be what you'll have for the following month to start up on top as your beginning cash when you're doing your cash flow projection. You can find this on Google if you're curious. And then the next one I talked about was profit and loss, which is also called income statement. And they're used interchangeably. So the P&L statement ties to the balance sheet through the equity and the net worth portion of the balance sheet by displaying profits in the form of retained earnings. These profits are generally kept by reinvesting into the company, such as paying down the debt and expanding the company. So this is a basic formula of a P&L statement. So you take the sales minus cost of goods sold, minus any overhead costs, so you know, salary, you know, rent, all that, and then that would come to the net profit. So sales, also called income or revenue, it's what you're getting from selling products or services that you have. Cost of goods sold is the total expenditure for inventory items which customers buy. Sorry, lots of talking. And the cost of goods sold consists of cost of purchasing items, freight, manufacturing costs, any types of costs associated. And then you would take that as gross profit, which is sales minus cost of goods sold. And then once you minus overhead, you'll get your net profit for your business. This is a very simple, basic formula to calculate for the P&L. And obviously when you think about it, if there's going to be a spreadsheet, there's going to be different line items associated for each one. But these are just, the main headings for those line items. So let's look at what a balance sheet takes into consideration when displaying financial data and how it's different from other statements. A P&L summarizes information about revenue, expenses, and whereas balance sheet yields information about company's assets, liabilities, and equity. It provides a snapshot at a point of time. It reports original costs, not operating costs. Takes into all consideration attributed to purchasing, purchase price, commissions, transportation, and appraisal. So again, it's a snapshot of how your business looks at that period of time. Kate's gonna go much more into detail about how that balance sheet looks like. So if you can turn to page 8 of your handout, the participants guide, there's an area you can fill it out if you like, but just some things to think about, for your business when you're considering to track your money is, the first question is, what are some ways you can use money tracking tools to project your business profitability, right? Knowing your value. The second one is, what are your goals for growth and what adjustments do you need to make sure you're staying on track? Forecasting your growth, right? Seeing how long can your business last, right? Like how long can your business be running for? And then lastly, for the lending opportunities, will you need to ask for additional financing to achieve your goals? What obstacles will you might face? These are just some questions to think about when you are running your business. If you want to take some time to think about it, please do. And if you have any questions on this, let me know. But these are factors to consider when building a banking relationship too, because we even think to ourselves, for your business. That's why a lot of times when you're asking for a loan, a lot of the loan lending products requires 2 years of business minimum to qualify for something, for a line of credit or a loan, only because we want to make sure that your business is profitable and you have the ability to repay. So I'm going to take a quick break. I'm going to pass it to my lovely colleague here, Kate. So I'm done talking now.
Get some food.
Did anyone take accounting 101 in the class? Any class? Accounting 2, 3? And I'm pretty sure you remember in your first accounting class, the first semester or quarter mainly focused on the 3 financial statements: balance sheet, profit and loss, and also what's the last one? Balance sheet, profit and loss.
Cash flow.
Sorry, cash flow. Yeah. So I know that many of you guys are business owners. Did anyone periodically or have ever seen your business 3 financial statements? You're only one. Okay, that is so true. Like for a business, if you start the first couple of years, if you have enough cash in your account, you make enough payments. Barely, you probably don't need to review it, or you don't have to have it to continue operate or make profits from the company. So, but then today we go over it mainly for a few key reasons. So first, it would be normally if you want to apply something in a bank. Did anyone apply for business loan in the past? Okay, perfect. So if in the future you ever want to go into a bank to apply for a loan, then for smaller loan amount, probably 20 to 30,000, maybe the bank is able to lend the money to you based on relationship. similar to how you get a credit card. But most of the time, most of the bank, if you're ever asking for more than 50,000, normally they ask for the full financial package. That's what they call it. So normally similar to when you apply for a mortgage. Anyone apply for a mortgage? Like when you apply for a mortgage, right, you provide your last 2 years tax return, provide your bank statement to convince the bank like, oh, I make enough money to pay back the loan. Similar at the bank, so when you're applying for a business loan, they first would ask for a personal and business tax return, your bank statement, and also they would also ask for this free financial statement. So that's why we're gonna go over it, because in the future, if you ever want to step into like larger lending, they will definitely ask for it. So like I know that it's like a bunch of introduction for like accounting and all the details, but you barely need to complete one by yourselves, because QuickBooks or your CPA will do it for you. But today we just want to explain to you why they're important, how you're going to review them, so then one day if the bank ever asks you, kind of understand what kind of factors that the bank is asking for. So think about it as if a friend is asking you to lend him money. Would you just give him the money? No, right? You're going to think about, first, I want to know how is his reputation. Does he gamble? Does he drink a lot? Right? Does he work enough to pay back the money? So first, I care about reputation. So, and then second, we're going to care about, does he work? Does he make money to pay me back? Right? And then third, we're going to think about, the worst case, if he couldn't pay me back, how do I protect myself? Can I get something? Like, if he doesn't pay back, I just take something from him. So that's easy to understand. And for business lending, actually the bank is doing the similar way. We think about the three ways too. So first, we want to check the reputation, right? We check the credit report to see if there are any late pay, any collections, any past due, to make sure that you have good paying histories. And second, we're gonna look at and then second, we're gonna make sure that you have enough cash flow. So we check your tax return, we check your profit and loss, we check your income statement, which you covered earlier. And then also the last thing would be, we wanna care about what kind of collateral that you have. Because like, even though bank is here to support business to make them grow, but of course we have to be realistic, right? If your business is selling like 100,000 a year, you want to ask for 3 million. Of course, the bank's not going to lend that money to you, so it has to be reasonable. So the last balance sheet actually would tell the bank what kind of collateral that you have. Yeah. So this is would be kind of how the this is what be how the balance sheet kind of looks like. So the reasons that the title is called balance sheet is because on the left side and the right side it will always be balanced. The total amount of assets would be equal to liability plus equity. Why? Don't worry about it. It's just accounting stuff. You never need to kind of like have one done by yourself. I just need to understand, like the left and right must be equal. If it's not equal, that means something wrong. Go back to your CPA, you need to fix something. Yeah, so on the left side, you have your assets, pretty much like what you own. And then on the right side, the top part is the liability, like what the owner needs to pay, the company needs to pay, and also have the equity. And this would be like an actual balance sheet looks like. But again, like depends on the industry, it would have different terms. Like for restaurants, manufacturer, healthcare, insurance agency would have like all completely different terms here. But this is how it looks like. If later you ever want to do one yourself, you can either like generate it in QuickBooks, or you can go to Google to Google a template and fill it out. Yeah. So on the left side is assets. Usually assets, it has like short-term assets and long-term assets, and also liability, the same. Short-term liability, current liability, and long-term liability. So from top to bottom, it will be more liquid to less liquid. And for liability, from top to bottom, it will be due sooner and due later, and owner's equity. And on the left side and right side, it will always be equal. So again, like the reasons that the bank want to look at the balance sheet, mainly because we want to know what kind of collateral that you have to secure this loan for you, right? So here would be like some most common samples of assets. Like for a personal account, normally if we check our accounts, we got the money in the account, then of course that's our money. But for business, it will be a little bit more complex, because most of the business, the assets might not be the balance in their account. Like for example, manufacturers, they could have account receivables, or for like insurance, the customer doesn't, even though they sign the contract, it doesn't pay until the due date, right? Or even for coconut, they place the order, but they might not pay you until certain times after. So when it comes to understanding business asset, it will be more complex than personal, because it's way more than only the balance in your account. So it could be cash or cash equivalent, like money order, cashier check, or like gift card, or it could be account receivable. Account receivable, you're gonna hear these terms a lot. It pretty much means you have completed the service to the client, you have delivered the good, but they have not yet paid you. Why the bank like it is because even though you don't have the money with you yet, but we know that at one point you will have it. So we do take that consider as that's part of your asset. And also inventory, because we know that they can be converted to cash soon also too, and prepaid expense. So usually the definition for current assets would be current assets are those which can be converted to cash within 12 months. If it's more than 12 months, it would be long-term assets. Yeah, long-term assets would be like your furniture, your equipment, your building, your land, your intangible assets. So why that important to the bank? So pretty much you can look at the long-term assets, equipment, building, and land. First, they're easy to evaluate. We can Google it, we can know their value easily, so that we can identify the value of the collateral. And second, like for land and building, their price barely goes down unless 2008 happened again. So if you have something like this, then the bank consider it as good, solid collateral. For example, if your friend's like, if I don't pay you back, I'm gonna give you my Rolex watch, I'm gonna give you my car, do you want it? Of course, right? Better than, I'm gonna write you a note, promise that I'll give it back to you, right? So that's why if it comes to lending, the bank consider long-term assets as like better collateral. Why that matters? Pretty much the better collateral, the more solid collateral you have, your interest rate will be more lower. Think about it, when you're gonna get a personal loan, when you're gonna get a personal auto loan, and when you're gonna get a mortgage. Of course, personal loan is the highest rate, right? And then auto loan in the middle, and the mortgage would have the lowest rate. Why the rate is different? It's mainly because the better asset, the more secure it is. So sometimes customers always ask, why my friend got 5%, why we got 8%, right? The collateral is different. Of course, to the bank, the better collateral, the lower risk. Of course, the lower risk, the lower rate.
I was just wondering, so how clear or unclear is the line between an owner and, for the building, for example, or land, right? Because it could be the owner that owns it, or maybe, so how do you distinguish that? Or do you just look at what the company owns?
Well, it's depending on like the actual title of who holds, you know, the title.
It mainly actually depends on loan program. This one is probably going to be a little bit confusing. Like for example, if you're going to do a smaller loan, then of course you only care what is under the business. However, if one day you're ever going to do a bigger loan, like for example SBA, and at that moment your business doesn't have any real estate. However, the owner is like, okay, I'm willing to put my personal asset as collateral, like using my house as collateral. Many of the banks able to accept that as the collateral. Yeah, so smaller loans, then we only, like quick and simple, we only look at what is under the business. If you're looking about something larger, usually like 250,000 or above, then or SBA, then it can be like a little bit more flexible. Yeah. Okay, so that's why we care about the assets. Yeah. Oh, and just to give you an idea, so back to the lending money to the friend example, right? Let's say if your friend got a vehicle that worth like 100,000. And he's asking you to lend him 100,000, would you say yes? Probably not, right? However, if you got a vehicle that's like worth 100,000, he's only asking for 10,000 to borrow, would you lend him? For sure, right? You probably even hope him that never pay you back so they can get So when you have the collateral to the bank do the same thing, which is based on the collateral, the value of the collateral, we would barely lend you 100% of the vehicle. It's gonna be a discount. For example, your commercial, your real estate worth like $1 million, we can probably lend you like half of that, 50% or 70% of that as collateral. So it's not gonna be like 100%. Sometimes customers upset like, I got 300,000 inventory, how come you're only lending me 100,000? That is why we wanna be more secure. Yeah, like even though banks here to support your growth, but they're not the charity, right? They want to secure and lower the risk as much as possible. And then sometimes when you're doing your tax, one thing I would bring this up here also, it would be another benefit, at least within the United States. If you have more assets, you will be able to depreciate it. And with the depreciation in the business tax return, that could be a good business tax deductible. So if you do have some business assets, make sure you check with the check with the CPA. Does those items qualify for depreciation? Okay, and then the next part, after we know how much we have, we're also gonna look into, so first the bank, they know how much you own, right? On the second side, they care about how much you own. For example, if the business only has net worth of $1 million, and right now the client's asking for 4 million, 10 million, would the bank lend to them? Probably not, it's out of balance, right? So then the liability part, it will list account payables, notes payable. It could be a bill, it could be a credit card that due soon, or it could be some like subscription expense monthly. Those are short-term liabilities, and we also have long-term debts. Okay, so usually when we talk about business lending, it's going to be either term loans or it's going to be like business line of credit. And then for this, it will be the one I guess most of the business owners are most interested about. So even though here only is term loans, commercial real estate, and loan from shareholders, in the real market, there actually are so many other different type of lending. For example, Teresa offers like account receivable lendings. In the market, there are also invoice factoring. There are also merchant cash advance. So even though your company might not qualify for most of the traditional term loans or line of credit, it doesn't mean your business cannot qualify for any lending. There are so many other lenders that can be more creative or flexible when it comes to the term loan type. I think Teresa is gonna introduce herself after intervention. Because yeah, after I hear what they offer, I'm like, wow, I need to schedule a follow-up meeting with you. Those are like something new to me. Yeah. Okay, and then the last part, equity ownership. So at least for small business, this one is usually like less important. It's more for like larger companies, like for larger companies. For smaller business, the most two common one is going to be owner's investment and retained earnings. So owner's investment, it would be the money that you input to the company originally. So why we care is sometimes the owner would use it to calculate their return. For example, if you have 50,000, you can either invest it for a limo company or you can invest it to a restaurant. So then they always want to compare their income versus their initial investment. And also return earning pretty much is a accounting terms. It says by the end of that, in the money, instead of paying that to yourself, it would stay at the business as return earning. Okay, the last thing is common sizings. So normally, like let's say today, you're going to submit the application at a bank. First, you're going to provide your tax return for last 2 years. However, the last 2 years is only for last 2 years. The bank will also want to care like how you're performing year to date. Why we want to look at that? Because many of the industry, they got affected hugely by the market. Like there are certain industries do much better because of COVID, and there are certain industries like perform worse because of COVID. So we always want to look at the trend. For example, if you're like a trucking company, last 2 years, your tax return is going to look amazing. However, the bank also want to look at your year-to-date performance, and many of them are not that great this year. So the bank always want to ask for the financial statement besides the tax return, because we also want to look at your year-to-date trend, which have not been reported yet. So sometimes if for the for the three financial statement, if they look similar to last year or they perform better than last year, then perfect. It makes the bank feel even more confident with working with you. However, if they see that, oh, this year the trend is going down a lot, then you might have some explanation to do, like why this year is not that good as the last 2 years. So that's why some clients, they have strong cash flow for last 2 years, by the end they got declined by the bank. Why? Because the trend is going down. So these pretty much are the four. So by looking at the balance sheet, pretty much like I just explained like how the bank consider it from the bank underwriting side. As a business owner, it would still be good to review it periodically because you can compare a balance sheet like current time and versus before. Do I have more debt? Do I have more inventory? How am I growing? Am I declining? Like by doing a comparison, it might help you to plan the future, plan the future better, and by looking at it from the big picture, not only just from how does my ending balance look like today. So here's the summary. We always want to track our, we probably at least want to look at the financial statement like once a year, just to make sure everything's on the right track, or if there anything doesn't seem right to you. And also we want to make sure that at least we're doing our accounting right. And also, the role of balance sheet is going to help the business owner to understand the value and the depth of the business. And also, the last thing we kind of covered, like separating your business account from personal account, will make it easier to build a financial report or tax report, everything will be easier. Yeah. That's pretty much end of the PowerPoint. Any questions for me?
Yeah, on page 14, that's intangible assets, amortization, what is that?
Oh, amortization? It's basically how they calculate the loan schedule. So when something gets amortized, like let's say it's a 30-year mortgage, right? The mortgage payment has principal and interest. So when they amortize it, you pay more interest towards the first half of your term, and then the second half you pay more towards your principal balance, and that's the amortization schedule.
So pretty much, I'm pretty sure after you got a loan, you always want to know how much interest, am I paying too much interest, am I paying too little interest last month? So what you can do is that you can always Google amortization schedule, enter your loan amount, enter the terms like the months, how many years, and then enter your interest rate. Then the amortization calculator will automatically break down for you, like, oh, last month you paid $500, but then 400 is the principal, 100 is the interest. So pretty much like for most of the loan in the market, even though your monthly payment is fixed, but then the amount of interest and amount of principal you pay is actually not fixed. Yeah, so by looking at the amortization schedule, actually would help you understand better by like how much interest you paid so far. And also, you would need that for your filing tax, because for business loan, all of the interest that you paid is also the write-off. So you might need that. Either you're gonna pull it out, or the CPA will pull it out for you.
And why is it called intangible?
Because it's not a physical asset. It's like, it's not a physical asset.
Okay, so normally when it comes to business loan collateral, the most common four type of collaterals would be buildings, inventory or equipment, or the last thing that you heard, account receivable, and the last thing is called general business asset. So that means you have a business today. It could be like you have your brand, like for example, you have a Subway, then Subway, the brand, it actually attracts more customer to you. So is that tangible? No, but the bank does consider that as valid collateral because they know that it's gonna help the business do better. So that's why they call it intangible. Yeah, so for like some smaller loans, sometimes the bank might not specifically get something from you, like less than $100,000. They could be just simply playing as UCC lien on your business. And by doing that, pretty much the bank is putting the lien for general business asset. Yeah.
So on that note, are there folks that gives you a valuation of your goodwill? Because it's intangible, or like a patent, right, too, right? As a patent is intangible. So how are there folks that kind of gives you the value? Does a bank have a folks?
Let's say if they're trying to, like a partner buyout, like they'll have a valuation.
It depends on the.
Yeah, so it depends, like but our line of business don't do partner buyouts, it's a higher segmentation. But let's say like you have a business, it's like, I don't know, a dentist, right? It's a practice. So you'll have a dollar amount in mind, like, oh, I wanna sell it for $5 million. But you think your business is worth that much. So there's different ways for them to value it, but then also it can be an agreement between the two, from the party to agree for that value too. So it just depends on the situation, but.
Right,
yeah.
but I guess in terms of the bank, right, I guess that's what we're asking here. How do you determine, because you're lending me the money, how do you, instead of the partners in buy now, right? Do you have a person that kind of looks at and go,
I can actually break this down to certain scenarios. So first one will be the one that Joanna mentioned. If you're gonna sell your company, you're gonna do merger and acquisition, like the real transaction, then definitely hire a specialist to do that valuation for you. That have nothing to do with the bank. However, today you're trying to get a loan from the bank. If you're getting something smaller, like 20,000, 30,000, 50,000, 60,000, like something smaller, less than 100,000, usually the bank doesn't go that strict. Yeah, we kind of tend to believe that you do have that because we look at your tax return, we know how much you make. So if it's less than 100,000 or like around 50,000, the bank won't be too strict about how much it's your real value. However, once you go above 100,000, then the bank take into all four of the commercial real estate, inventory, account receivable, and general business asset into consideration. I have to be super honest with you. If you're getting a loan more than that's like between lower than $1 million but above 100,000, the goodwill, the brand name, it's less important versus all the other tangible assets you have. But of course, if you're going to go larger, get a bond, get something more complex, then that will really depend on the underwriting guideline from the bank.
Well, Dennis, also, sometimes for mergers, right, when you or acquisitions, that's the point of negotiation. How much is in each category because it affects the tax treatment. So I think that's also one of the reasons people kind of adjust it based on what they want to do for taxes.
Mm-hmm. Then, for example, we can go deeper, right? Today, let's say you're gonna buy another dentist's office, and you and the dentist decide that, oh, this branch worth $3 million. You come up with that valuation. Does bank really gonna lend you the $3 million based on the valuation? We look at the tax return. Yeah, if your company or his company is making that much, then since you're agreeing in borrowing the $3 million, you got a cash flow, then we can go ahead and give it to you. Right? But then let's say even if the valuation come back says it was $3 million, but then your cash flow is you got a loss last year, then you're probably not even gonna get 50,000, right? Yeah. So the valuation is more for the buyer and seller. That would be the key situation. Figure out the worst. Yeah.
Any other questions?
I do have one question. For personal finance, the net asset, it's your basically your liability minus your total. Okay, so what I'm trying to say, what I own, my total assets minus liability, that's my net assets. But how come in the business world, it's kind of reversed? Because the equity is actually your net worth, basically, right?
Not necessary. The business network mainly comes from valuation. We put your assets together, we put your cash together, we put everything together. That's the valuation. If you're trying to figure out the net income, that comes from the profit and loss.
Oh, okay. That's probably why you call it different. Okay.
Yeah. So that would be slightly different. The reason that it's easier to figure out personal asset is just simple, right? How much I own, how much I have minus how much I own.
Right.
But then for business would be different. I'm gonna give you this example. For example, you got a huge building. You got the loan with East West Bank. Then does that matter to US Bank? No, because if you go default, that collateral belongs to East West Bank. My bank have nothing to do with that. So for me, I'm more care about, do you have extra cash flow? Do you have extra collateral that I can secure? What you have with other banks doesn't mean anything to me, because legally you have the loan doc. They're gonna secure it if it goes default. That's why. Yeah. Thanks. I see you raise your hand.
Yes, last time I had this kind of clauses, the professor told me, because we don't need a loan right now, but he stressed me to do a loan. As soon as earlier that you can, because of the credit histories.
Good question. Okay,
So-
so it's not included in this PowerPoint, but I'll go deeper. When it comes to business credit product, there are actually two most common ones. One is a loan, one is a line. Anyone heard about business line of credit? Okay, so for a loan, it's good for when you know how much you need, when you're gonna spend it, and how you're gonna spend it, because your monthly payment is fixed, everything is fixed. If you are not sure if you're ever gonna need the money, you just wanna have some backup funds, line of credit would be a better option, because in that case, you're not paying any interest if you don't ever use it, but yet you have the ability to get capital if you ever need it. right? So when it comes to credit building part, yes, both of loan and line will start building the business credit history. Even the business credit card will start building it. But if honestly you don't need a loan, don't get a loan. You're paying the interest. And right now we're at the highest point. If you just want to have some backup fund, you want to like start building business credit history, a few good starting point would be, for example, first, get a vehicle for your company. Yeah. Second, get a line of credit. And third, get a credit card. Or if you're ever going to purchase any equipment for the company, then do a small loan for that as well. Those could be a good thing. Those could be like a few good scenarios. And however, when it comes to business loan versus personal loan, we care so much about your personal credit history. Right? If you have lending history, then we can lend you more without checking your tax return or pay stub, like how you get an auto loan. But when it comes to business, even though you could have strong lending histories, but let's say if your tax return sucks, does it gonna make the deal work? No. Still gonna be like credit history plus your income and the collateral.
So when you say buy a car, don't buy it cash then. Buy through a loan.
No.
Okay.
Who buy car in cash?
So
Well,
there,
no, because
so there's a lot of instances where business owners use their personal vehicle for, for business, right? So what Kate is saying is that if you're doing that right now, you technically can make that into a business loan under your business name, or if you're looking to get a separate car specifically for your business, you can do that. But no, you don't ever want to buy cash because you're going to deplete your savings, whether it's for your personal savings or your business savings.
Yeah. So a few common reasons that my customer decided to buy the vehicle under the business could be one, that it's really used for business. You're gonna have a driver, you're gonna have an employee to drive that vehicle. Do you want to give your personal vehicle to him? No, because if there any car accident, your personal insurance is gonna go up highly, right? So first, that situation would be your business is really need a vehicle. The second situation is more for professional, for example, insurance agents, advisor. Sometimes do you need a vehicle for business? Not necessary. You're using your personal vehicle. Why some of my customers want to put it under the business? Because the depreciation write-off. That would be the key part. Depreciation. Yeah. So and third, another benefit would be by putting the vehicle under the business name, like for example, the business auto loan at US Bank. It's not listed under your personal credit report at all. It's only under the business credit report. So that means if one day you're gonna buy another house, with or without that monthly payment on your personal credit report, it makes a huge difference. That could be another reason. Yeah. And then the third reason, it could be sometimes some industries they must have certain license or certain insurance, like transportation or construction. So for them to get the commercial license, they just must have a business auto loan. A personal auto loan won't get them a commercial registration. That would be the key three factors to put the vehicle under the business. However, there's some pros and cons. I'll be honest with you. I have clients. He is a business owner. Does he need a vehicle for a business? No. He's just putting the vehicle under the business for write-off purpose. And he ran into a car accident. And then the vehicle that was injured, he see that the commercial registration has the business name. So normally, if you have a personal auto loan or personal vehicle, that is only like between personal. Just because the car that he hit saw that is also under business, so he's going after the business. So there's some pros and cons. Before you do it, definitely check with your lawyer and your CPA to make sure you understand the full picture, like the benefit and some kind of potential risk that you're getting. Yeah.
I also want to add, I think what Kate and Joanna talked about is so important, especially for small businesses. A lot of the companies that come to us wanted to get loan, but then they don't know. Sometimes it takes a little effort to plant the seed, to pave the road in order to get that loan. Sometimes, clients, they want to save money to show losses. They want to avoid paying taxes. But then eventually, when you need the loan, it will hurt you. Then, either you cannot get a loan or you have to pay high interest. So,
They never show, because they never show profit.
Right, they show loss.
So they can't even get the loan.
Yeah, right, it's very hard. Or you have to go to the second tier, third tier, smaller lenders at high cost.
Yeah. Or at that point, you restart your clock. You have to wait 2 years.
I'll go a little bit deeper. So if the business is having a loss on the tax return, does that mean they won't qualify for any loan? No, not necessarily. It really depends on why it's negative. Yeah, for example, last year you have a loss mainly because you're doing remodel of your warehouse. Then the bank, of course, we understand that doesn't happen every year. It's not a fixed expense. Will we be able to explain it to the bank to explain the loss? Potentially yes. Or for example, you have a huge depreciation from the commercial building or the vehicle you own, then your business have a loss. Would the bank fine with that? Totally, we understand depreciation is not money out of your pocket. It's just a write-off method, so that's also fine. So I would say if in the future you're considering getting some business lending, definitely always have a good relationship with one of the business banker, business relationship manager at one bank. Plan something longer, like I want to do something in 1 year, 2 years, 3 years, how should I start preparing? At least get the basic understanding, so when you really need the money, you're not shocked by, oh, I couldn't do that. I didn't know that I need a loan above 680 FICO score, right? You're not shocked. At least you know under what situation that you could qualify. Yeah, so what I do with my customer very often is that we at least can meet once a year. Like, oh, by looking at your tax return, if you're gonna apply for a loan right now, this is kind of estimated amount you can qualify. So at least you have a better idea for like, oh, by reporting my tax, by doing my financial statement this way, how would it impact you? It only takes less than 30 minutes for the complete meeting. Yeah, so sorry, I actually don't have my enough business card with me today. So if you do have any like specific questions regarding to your industry or your business, or you want to plan something future, or you have some questions regarding to any lendings or credit, or even for your clients, I know your clients too, feel free to schedule a meeting with me. I can definitely like go over your special situation and let you know like, oh, at least from banking perspective, for your industry, this is usually how that works.
Dennis, are you able to send out Kate's contact to all the leads? Okay.
All right, well, thank you, ladies. One last one I'll make and we'll get out of here. So, you know, I tell this